Hi, the market has recovered and reached back to an all-time high level. Personally, whenever this happens, I tend to slow down my equity investments and start putting in some money aside for whenever the market corrects. And my usual strategy involves continuing all my normal SIPs into equity while building a debt basket, while building or putting money into gilt mutual funds. And whenever this correction happens, I decide to put the money back into the equity markets as a lump sum. Okay, continue doing my SIPs and then build a rainy day fund for whenever the market corrects. We here in the channel adopted the same strategy when the equity markets corrected near the end of 2024 and the beginning of 2025. And when I was deciding where to put my money into right now because the market looks a bit overvalued, I found out this one very interesting asset class instead of my regular gilt fund investments. What are they? Arbitrage mutual funds. And that is exactly what we are going to discuss in this video. First, let's understand why a lot of people are investing money into arbitrage mutual funds right now. The AUM in that asset class is doubling every single year. And then we'll get into what these arbitrage mutual funds are in the first place. How does it work? Why does it work? And we'll also get into few disadvantages that you should keep in mind before deciding to invest in them. So if that's the case, what are you waiting for? This is Ajay Ajith. Welcome to Market Feed. So come, let's start with the presentation that I've made for you here, and it's titled Short-Term Investing Opportunities. So even if you're a long-term investor, if you want to replace the debt funds and the FDs in your portfolio, you can still do that. But for me personally, as a trader, as an investor, I'm going to use it for short-term investing opportunities. And let's start with the first slide, which is why shift to arbitrage funds. So the logic here is very, very clear. Arbitrage funds offer control over taxation while maintaining similar returns to debt funds and FDs. We are not going to optimize the returns this time. We know returns might be very similar, but what are we going to control? It is the taxation part. For you, a lot of you watching this video, it might be very useful to save a lot of tax and hence increase your net returns after taxes. So let's get into it. All debt funds are now coming under high taxation rules after the budget. That is the difference, or that is why arbitrage funds are being very, very lucrative right now. And because of that reason itself, AUM under these funds are doubling every single year. HNI money is flowing very, very strongly into these funds. But before investing, we really have to understand this concept well. Let's not blindly invest into any asset class just because we heard it in a YouTube video. So let's go ahead, understand it deeply before you decide whether you have to invest in it or not. So what are arbitrage funds? We'll start with a theoretical definition first, and if you don't understand it, we'll quickly go ahead and simplify it. So arbitrage funds are a type of hybrid mutual fund that aims to generate returns by exploiting price differences between the cash and derivatives market for the same asset. What does that mean? Essentially, they buy an asset in one market, like the spot market, the cash market, and simultaneously sell it in another market, that is in the futures market, at a higher price, locking in a profit. So you might have noticed there is always a difference between the spot price and the future price for any stock or even for Nifty also. And whenever you try to take advantage of these differences, price differences, it's called as an arbitrage opportunity. And these mutual funds focus only on that, identifying price differences and then making money out of it. But if you think this is trading, do not worry. Risk is low here in arbitrage strategies, and that is why FD and debt fund investors appreciate it really well. So then why are investors preferring it? Low risk arbitrage strategies give an alternate for debt funds and FDs like we discussed right now, and also tax benefits and returns for arbitrage funds have become very clear over the last few years. People have started putting money into it, and the entire ecosystem is very clear on how it works, what are the returns, what are the taxations, and everyone is actually liking it right now. So that is why smart money is moving into arbitrage funds. Now, the next question is, what are the returns? Arbitrage funds are able to deliver 6 to 8% returns similar to other safe investments. and it is classified as low risk investments by all the mutual fund companies out there. Now, what did we discuss all the time here? There are a lot of tax benefits, and these tax benefits is why you should invest into these funds. So let's go ahead and look into what is a major difference between debt funds and FDs and these arbitrage mutual funds. So okay, first let's get into the tax treatment here. Debt funds and FDs, profits are taxed as other income. Okay, for debt funds, it's the profits that you make, or for FDs, it is the interest that you make. It is classified as other income, and it is tax based on your income tax slab. So if you're someone who is at the highest tax slab, you'll end up paying 30% of the interest or the profits earned after the sale of these funds as taxes to the government. Now, when we are looking into arbitrage mutual funds, they are currently taxed as equity under and taxed under capital gains tax. So, equity, as we all know, comes under capital gains tax, and here long-term capital gains is only 12.5%. That is, if you're holding for more than 1 year, you need to only pay a tax rate of 12.5% on the profits that you make. And if it is short-term capital gains, that means if you're withdrawing your funds before 1 year, you have to pay 20% as tax on the profits that you make. So what is the difference here? 30% on one side and at the maximum 20% on the other side. If it's long-term capital gains, you have a much lower rate also. And there are certain waivers that you need to understand as well. So when you're going into arbitrage mutual funds and long-term capital gains, whatever profits that you make up to 1.25 lakhs per year, you get a waiver. There is no need to pay any taxes on a profit up to 1.25 lakhs. Now that is significant. For most people that will be enough, but even after that is where you have to start paying this 12.5%. So the effective tax rate here is very, very low, especially in long-term gains. And that is the extra added benefit here that a lot of people are trying to take advantage of. Now the next question is, what are the biggest funds that you need to know of here? Come, let's quickly check that out as well. So come to your broker's mutual fund dashboard and you can type in arbitrage funds. So you can see the highest or the biggest fund here is Kotak's arbitrage fund. There are also other opportunities like SBI, ICICI Prudential, but let's start with Kotak here. So what can you see here? Over the last 1 year, it has given a returns of 7.65%. Wow, sounds good. Then let's look at the expense ratio. Expense ratio is 0.44%, which is also decent. So no need to worry about that. Exit load is also good. So you can see here, if you're holding for at least 30 days, there is no additional charges that you have to pay here, which is very, very similar to a debt fund. So you can see all of this is really good and the risk involved here is very, very low. Now, if SEBI and mutual funds themselves are calling this as low risk, you can believe it, right? And that's what is happening here. When you come down into the holdings of these mutual funds, you can see that they hold nearly 15% of their cash in debt assets. Okay, they also hold it in debt assets. That is, they're putting money into Kotak's money market fund and Kotak's savings fund. But the rest of the money, nearly 85%, is put into equity, and it is always hedge trades that they're running. So don't worry if HDFC Bank falls a lot by tomorrow. There is no risk or no threat to this fund, because if you're looking at this chart, you can see over the last many years, it just keeps on moving slowly up, just like a debt mutual funds. Yes, I'm not saying it won't have any drawdowns. Over the last 1 year, there have been small drawdowns of 1%, 1.5%. But over the last 1 year, you can see it's confidently, slowly going up, and that is the style of this mutual fund. You can see the same for SBI's fund as well. Here also, the expense ratio is low at 0.4%, and even after this expense ratio, it has been able to make a profit or a CAGR of 7.56% last year. And even if you're coming into 3 years, it is the same, and you can come even into 5 years, and you can see that in 5 years, it is 6%. That is okay. What are we aiming for? We're looking for a replacement for our debt funds and FDs, and 6 to 8% is what we are anyway expecting. So that is what these funds have been returning over the last many years. So very short, simple, sweet concept. I was personally looking for a place to park my extra money as a rainy day fund when the market corrects, and I found this as a great opportunity for me to do so. Now you might be thinking, should everyone do it? Should you also do it? That's where I have one more layer for you to think upon. So if you're coming under the 12 lakh income tax slab, then you're already paying zero tax. Then debt funds would mean that you can still enjoy the zero tax. If your income is, let's say, 5 lakhs per annum or even 7 lakhs per annum, even with the profits of these debt mutual funds, you won't have to pay any additional income tax. Why? Because it is coming as per your tax slab. If your tax slab is anyway zero, you can continue to enjoy it. But if you're already a heavy taxpayer with your current income already, it is best to shift to arbitrage funds for all these opportunities. Now, the same is also applicable even for FD investors who are also taxed under the tax slab system itself. So I hope that you understood the concept really well. That is, what are arbitrage funds? It is a strategy-based mutual fund which finds price differences between different assets and tries to make a steady profit along it. And the returns are 6 to 8% historically, and the risk involved is very, very low. So the picture is very rosy here. Everything looks too good to be true. Then what is the question here? What are the disadvantages? Let's quickly discuss that before we wrap up the video. So the first disadvantage here is that our arbitrage opportunities in the market might reduce as more AUM gets pumped in. That means if more and more money is going into these arbitrage mutual funds, the opportunity to find these price mismatches might reduce in the market. And that is one major disadvantage here. It has not been observed. Even though the last multiple years the AUM has doubled, it has not been observed yet. But this can happen at a later time. Until then, we can still enjoy these benefits, right? So that is okay. 2, debt funds don't have this problem. They'll always have enough and more AUM capacity for anyone and everyone to put in thousands and thousands of crore into those mutual funds. But for arbitrage funds, there might be a threshold, but we are not sure exactly where it is. But currently, all the funds are giving decent returns between 6 to 8%. So we are happy. Now, what is a major disadvantage here? The government might try to close this tax loophole. So how does this tax loophole work? Even though they're investing most of their money into equity, their strategies is not to buy equity and hold it for the long term. It is that they take equity and they take counter positions in the futures market so that it is a strategy based mutual fund. I'm hoping that the government will not change their decision here, but that is a hack that we are exploiting, and the government can close this loophole at any time. But again, as I said, until that time, we can still continue to enjoy all of those benefits while getting really, really good returns. Now, before wrapping up this video, I just want to make one thing really clear. I've not stopped my SIPs into equity altogether. I'm continuing all my normal SIPs. But when it comes to discretion based investing, when I'm putting in extra money into the market, right now it does not look like a good time for me. So there I'm trying to build a corpus that is separate from my equity investments. So personally, I would also suggest this to you. It can be a good opportunity for you to start building that extra corpus for you to take advantage whenever the market falls. Again, I want to make clear that none of the topics that we discuss in this video are investment advice. Make sure you always consult a financial professional before you decide where to invest. So I hope that you got a lot of value from this short and sweet video. Comment down if you have any questions and leave a like if you like the content here. If you want to see more such videos, make sure you hit the subscribe button as well. This is Ajay Ajith signing off. See you all. Bye bye.